Are the beaches still closed in Broward County?
I thought they were open, but I don't know.
Otherwise, it's going to be a repeat of spring break where they're all going to be pushed here to Delray.
Very possible. Okay, let's go ahead and get started. So basically, today we'll be kind of wrapping up with this, what I'm, or the textbook and I'm both, sort of calling kind of our prerequisites to jumping into the hardcore sort of real estate finance material. And so we're going to, some of this today will be a little bit of a repeat from previous weeks, which is a good thing, because those of you that have spent some time reviewing basically the problems and that sort of thing from the previous sessions, some of this will basically then hopefully kind of reinforce and you can be that much more comfortable with kind of everything that we've done up to this point. And then we'll be adding a few new things today as well. All right, so the first thing we want to jump off into is amortization, and specifically an amortization schedule and setting one up. And what we're going to do initially is just kind of explain how it works and then show you kind of how to get the information using the calculator and kind of go from there. All right, so the first thing that we want to do is get our basic sort of loan information. So in this case, let's just say that we've got a $100,000 loan, and give me an interest rate.
7%.
7% interest rate. Okay, and then give me a term. How many years?
15.
15 years. All right, so the first thing, let's just go ahead and kind of get what we've done up to this point kind of out of the way, get our payment. And this is going to be a monthly payment, so it's going to be 12 payments per year up here. $898.83 as our monthly payment. Okay, nothing new up to this point. Okay, now let's construct our amortization schedule. So an amortization schedule looks pretty much like this. Now you're going to see some minor little variations in this, but this is pretty much what it's going to look like. Over here on the far left, we're going to have, in essence, the period number or sort of payment number. And so in this case, it's going to be on a monthly basis. So we're going to do like the first, let's say 3 months, just so you can kind of get the idea of how everything works. Then the next column is going to be the beginning balance of the loan for that period. So in this case, in month number 1, we're starting off with a $100,000 beginning balance. Okay, then the next column is going to be the payment amount for that month. So $898.83. Then the next column over is going to be the interest paid, which we don't have yet. Then the next column is going to be the principal repaid, and then the last column is going to be our ending balance. Okay, so once again, the schedule that we're sort of creating is just called an amortization schedule, all right? And so it's going to show on a month by month or period by period what dollar amounts are going to be sort of in each of these categories, starting with the beginning balance, payment amount, interest paid, principal repaid, ending balance, so forth. Okay, now the first thing I like to do, just in terms of explaining this, you're not going to have to inherently do this other than I want you to understand it. Okay, so this is one of the pieces of where are these numbers coming from. All right, so let's start with the interest paid. for this particular problem. So what we would do to get interest paid would be to take $100,000, multiply it by the interest rate of 7%. Then, once we've got that, which is 7,000, that's in essence an annual number. We need to divide that by 12 to get a monthly number. And so we end up with $583.33. So that is what's going to pop in here. Okay? Does everybody understand what we did? Okay? Now for subsequent months, that number is going to change depending on how much our beginning balance was. You can see it could be a very labor-intensive or calculation-intensive sort of exercise, but we're going to obviously simplify it here in a few minutes by using the calculator. Okay, now for the principal repaid, that is simply taking, if we want to label these columns here for a second, I'm going to label them with letters just so you kind of get an easy sense of what they are. Okay, so we got, let's say columns A, B, C, D, E, and F, just like you would kind of on Excel. All right. So column E, the principal repaid, is basically equal to C minus D. Okay, so you're simply taking the payment amount minus the interest paid. Okay, so in so doing, you should end up with around $315.50, let's say rounded. Okay? All right, does that make sense, everybody? Yes or no? Okay, now this is easy, but this is where people will make the most mistakes whenever constructing one of these. The ending balance is what? The beginning balance, which is B, minus, no, that is the most common mistake, okay? It is E, minus the principal repaid, okay? Because you're not reducing the loan balance by the payment, you're reducing it by the amount of the loan that you have paid off thus far, okay? The principal portion only, okay? So in this case, if we do this, so 100,000 minus 315.50 will give us 99,684.50. So that would be our ending balance for month one. Okay? So now the beginning of month two, how much do we owe? Well, that balance from end of month one. So we owe 99,684.50. Okay? All right? Now, our payment for this normal sort of loan is going to stay constant at the $898.83 because it's a constant payment mortgage, a normal mortgage. All right? But now our interest paid for that second month, is it going to be more, less, or the same as the previous month?
Less.
Less. Why? Because we owe less. Okay? In other words, now we only owe $99,684. So, in essence, what's going to happen is you're going to take the $99,684 and you're saying, oh my God, are we going to have to do this for every single? No, you're not, because the calculator is going to do this for you. But I just want to show you how to do it by hand first so you get an idea of what's actually happening. Okay? So $99,684.50 times 7%. You get 69.7792 rounded, divided by 12, and you end up with 581.49. Okay? Then the principal repaid, we do the basic math on that. And we end up with 317.34.
Oh, wow, I got it.
Okay. All right. And then finally, our ending balance.
Yeah, I got 316.84. Principal repay.
All right, so 99, 367.16. Okay, you're saying we got what, I'm sorry?
316.84.
All right, let's just take a look here. 898, 83 minus 581, 49, 317.
That's weird.
Okay. Now, in essence, we may have some little minor things due to rounding, which is okay for this.
Okay.
367, 16, payment stays 898, 83. Okay. So we're going to stop there for a second, and now we're going to show you how to do this on the calculator, okay, without having to do all these calculations. So if you go back up here to our original little calculation, all right, so go ahead and put that back in, because you probably have erased stuff since then. So we're going to put all of that back in. I'm going to kind of draw a line down here since I'm running out of space. And then you're going to do the following. You're going to do 1, input 1, shift, amortization, and then hit the equal sign. Okay, so let's start with that. Okay, so you should get 315, obviously, if you carry out the decimal places, 4949, so forth, but rounded 315.50, which then obviously corresponds up here to the principal repaid. So in other words, hitting that equal the first time is simply going to give us what is the principal amount for that loan. Does that make sense? Okay. Hit the equal again, and you get negative 583.33, which is obviously the interest paid. You hit equal again, and you end up with 99,684.51 rounded, because it's obviously kind of taking into account all of the extra little pennies floating around here and there. All right. So everybody match up with that? Yes? Okay, good. Now, for the second month, what do you think we're going to do? Two input 2. Why not 1 input 2? 1 input 2 would give us month 1 and month 2 added together. We don't want that. We want just month 2 by itself. Okay? Okay, so let's see what we get. All right. 317.34 rounded, which obviously corresponds with what we've got up here. Okay, we hit equal again. 581.49, which corresponds up here. Hit equal again. 99,367.17 corresponds here. Okay. Everybody still with me?
Yeah.
Okay? Now, let's go ahead and fill in month 3. Obviously, you've got all these lines running around there, but that's okay. Okay, so 3 input 3, shift, amortize, equal. Okay, so 3, 19, 19. So we just pop that in up here. All right. Hit equal again. 5, 79, 64. Hit equal again. 99, 04, 7, 98. Okay? Everybody good? All right. Now, let's jump around a little bit. Okay? So what if I were to just simply ask you, and I will ask you something like this. What is the amount of principal that you repaid during month, give me a month, any month from basically, we can do up to 180 months. So just pick a month at random.
120.
120. Okay, so we want the principal for month 120. So you're going to do the following. 120, input, 120, shift, amortize, equal. And if I ask you just for the principal, it's just going to be this first number. Okay, that is the principal. So let's see what we get.
Minus 630 to 36.
Okay, $630.36. Does everybody follow? Okay. Now, we'll stop there on the principal one. But what if I ask you now for another month, but I just want to ask you for the interest? Okay, so give me another month.
50.
Okay, month number 50. And for month 50, we want the interest. So here we're going to basically hit the equal twice, because what we want is the interest.
479, 29.
479.29. Okay? All right? Now, okay, let's come back. Okay, give me another month that we want to find what the balance is at the end of a particular month.
27.
27.
And this is all without ever hitting clear on the calculator.
Correct. Oops. That is a 27. Okay.
$90,803.13.
Okay. Okay. Everybody good with that? Does that make sense? All right, now, let's do something a little bit different. Okay. So right there, those are 3 questions on the quiz. Okay. So if you know how to do that, you've got 30 points right there. Okay. Now, what if I asked you to give me the amount of interest or the amount of principal over a period of time? Okay. So let's pick a period of time, okay? Give me a year. Any year from 1 to 15.
Fifth year, end of fifth year.
Okay. What I want is over maybe 5 years.
Nice.
Okay, or over the 5th year itself. We can do it either way. What do you want to do? You want to do it the entire 5 years or just year 5?
The
Entire 5 years.
Okay, so the entire 5 years would be what?
1.
What are we doing after the
60.
entire 5 years? What are
Just
we
finding out what the principal, interest, and balance is. Okay? So one input 60, which is 5 years times 12, 60 months. So the principal over that entire 5-year period was $22,587, 1920 rounded, okay? The interest, $31,342.50 rounded. And the balance that we still owe after 5 years, $77,412.80. Okay? So what we've done there is just simply ask for what is the cumulative or total amount of principal that we have repaid on the loan. We have asked for the total interest that we have paid during that first 5 years or 60 months, and we've asked for what is our balance at the end of that 5 years. Now, for those of you that are thinking about this, what two numbers of those three numbers can we add together and get our original loan balance?
What's paid on
The
the balance?
principal and the principal payment and then the principal
Yeah,
balance.
if this is our principal, this is our balance, so if we simply add those two numbers together, we should get our original balance of 100,000. Okay, is right with me?
Corey,
Yep.
why do we have to use 60? Why don't we
Okay.
use 65?
5 years.
In this case, we're going to find after 5 years. So 5 years times 12 months in a year, 60 months.
Okay. Even if the calculator is already set for months, you still have to.
Yeah, because in this case, what we can do, because we don't even have to use it on a monthly, in other words, we can pick any period. Like for example, I can just randomly say, I want to know month number 3 to month number 23. And that doesn't really correspond to years, so it's just much easier whenever you're doing this, you just sort of think of it in months or in periods. Okay? Because one of the things that in real estate that is important is we need to be able to calculate the amount of interest that was paid over any given year over a loan, because that's tax deductible, okay? For whether it's on your personal residence, it's deductible as, in essence, one of the deductions that if they obviously add up to enough that, you can itemize. But on business or commercial investments, it also is a deductible expense to write off the interest portion of a loan that you paid during that year. So like for this loan, if we were to pick just year 1 as an example, we could say, okay, during year 1 or 1 input 12, we hit equal, we're going to get the interest portion. Which is like $6,876.14. Then we would be able to say, okay, that is the dollar amount that we would then be able to use as a income tax deduction offsetting whatever income we've generated. Does that make sense? Okay. So that's one of the reasons why, I guess, that I'm getting at, we need to understand and use amortization schedules to be able to get at bits and pieces of information that are useful to us. That's one of the things that we need, is the interest that we paid typically over a year. But we also need what we've been doing, which is like, what is the ending balance? Because if we're going to pay off the loan early, we need to know how much we owe. Okay? So that's the reason why we need to use this. In addition, it also kind of gives us a little bit of perspective of, over time, how do these numbers, in essence, change? That, as you owe less and less as time progresses, your payment amount is staying constant for a normal constant payment mortgage, but yet your interest is going down, 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 down because you owe less and less and less. Whenever you get to an essence like that final month, let's just take a look at that just as an example. What would the final month in this loan be?
180.
180, which is 15 years times 12. So let's go to month 180 and see what it looks like. So what you should see is very little interest because we owe very little at that point.
$5.21.
Okay, so we got $893.62 for the principal. For the interest, $5.21 for the interest, and then our balance should be 0 because we've now paid off the loan. Okay, does that make sense, everybody?
Question, can we still use something like this if, say, yeah, my payment is $898, but I'm gonna go ahead and pay $1,000 a month to knock principal off? You can use the same type of thing?
Yes and no.
Okay.
And that's going to be more advanced, and we're going to get there.
Okay.
Be patient.
I will.
Okay. All right. Is everybody comfortable with this? Yes or no?
The only, I have an issue about, well, not an issue, but I get confused with what to put in as the 180 versus 1.
Okay.
You know.
Think of it like this. So it's really simple once you conceptualize it, which is just think of it as this is the beginning point, this is the ending point. Okay? So if the beginning point that you want to start with is, in this case, month 1 through month 12, it's going to be 1 into 12. But if what you're really just wanting to capture is just 1 month, then the 180, we start with that through 180, that's only going to be that one time period. Does that make sense?
Yeah, okay.
Okay. All right. Move this forward. Okay, let's kind of walk ourselves back a little bit to last week. One of the concepts that I introduced that is going to be on the quiz again this week are interest-only loans. Okay? So, first of all, just a repeat. What is an interest-only loan?
You only pay back the interest and not the principal.
You only pay interest on the loan. What happens with your balance?
Doesn't go down.
It doesn't go down. Okay?
And you still owe it.
You still owe it at the end. Okay? Now, so once again, let's work through an example. Okay, give me a dollar amount for the loan.
150.
150,000. That's what I'm hearing.
Yes.
Okay? Give me an interest rate for the loan.
7%.
What?
7%.
7%. Okay? 7% interest rate, and give me a term.
15 years.
15 years.
Doing the same thing over.
Well, that's what the people gave me. Okay? All right.
Small numbers.
All right, so with a $150,000 mortgage, 7% interest rate, 15-year term, okay? For an interest-only mortgage, which of those pieces of information really doesn't matter?
15 years.
The 15 years. Because whether the loan is 1 year, 5 years, 10 years, 100 years, if it's an interest-only mortgage, it really is not going to affect anything if in terms of the term, because you're never going to pay it off, okay? So all that really matters for the interest-only mortgage is just the dollar amount and basically the interest rate. And even to a certain extent, monthly versus annual doesn't really matter that much. I mean, you still are going to need to calculate what the payment's going to be maybe on a monthly basis or on an annual basis, but because you're not touching any sort of principal balance, there's no impact, if you will, on the principal balance. Therefore, you don't really have to make time value of money adjustments, I guess would be the way to sort of express that. So, in this case, with 150,000 times 7%, that's $10,500 of interest per what?
Month. No, I mean year, sorry.
Per year. Okay? Per month, we'll be dividing it by 12. So $875 would be the interest per month. Okay? Does that make sense, everybody? Yes or no? That would be your payment amount for that interest-only mortgage. Now, if all I give you is the $875 per month, and I ask you how much is the loan amount at a 7% interest rate, all you've got to do is what?
Divided.
So this is kind of, we'll work it backwards. You're basically going to take the $875 times 12 to get $10,500, and then you're going to basically divide that by 0.07, which is the interest rate, and you're going to find the loan amount is $150,000. Okay, does that make sense, everybody? So in other words, you need to be able to work it backwards and forwards. Okay, so if I give you the dollar amount and I give you the interest rate, you should be able to figure out the actual loan amount. Or if I give you the loan amount and the interest rate, you should be able to figure out the payment. But you should also be able to figure out what? The interest rate. What if I simply say that your annual interest is $10,500, and I say, okay, your loan amount is $150,000. You get 0.07, which is the interest rate. Okay? So it's basically the same, almost the same exact formula as ERB for all intents and purposes. Okay? In terms of, but here we're dealing with an interest rate, and we're dealing with the value, and we're dealing with obviously the amount, or the dollar amount of interest and the interest rate. Okay. That's that.
Professor.
Yep.
So the 15 years is basically just establishing the term of the loan,
Yeah.
right?
So it's meaningless to us because, in essence, with an interest-only mortgage, I mean, yes, that may be the period of time that you've established with the lender that you're going to have this relationship of you making these payments, but what's going to happen at the end of that 15 years is simply you're going to have to either refinance the loan, pay off the loan, you know, sell the property, that sort of thing, but you're still going to owe the original $150,000 even after the whole 15 years is up. Does that make sense?
Yes.
Okay. Okay. So that's another question on the quiz. All right, just so you know. All right. This is a new topic for the day. And it is contained within the textbook, just so you know, as are these others. Okay. These three basic mortgage types, we've talked about two of the three. The first one is the normal mortgage, which is we call the constant payment mortgage. Then the one that we just talked about, we could call the basically constant interest mortgage or interest-only mortgage, that sort of thing, okay? That'd be the second type. This third type is the one doesn't get used as much, but still is used, and you'll kind of see the benefit of it. It's called a constant amortization mortgage. So what do you think that means? Just the name, constant amortization.
The payment's the same, the interest is the same every single month?
No. And listen to this very carefully. In the constant payment mortgage, what is constant? The payment, yes? But every month in the constant payment mortgage, what changes? The amount of interest that you pay and the amount of principal you repay, correct? Yes?
Yes.
Whereas in the constant amortization mortgage, what we are holding constant is not the payment amount, it is the principal amount. So in other words, you're paying off the same amount of principal each period, okay? It's an easy calculation by hand, can't really do it effectively on the calculator. It's more of you kind of have to understand it by hand. And let me explain how it works. So let's say that we have a $100,000 mortgage. All right? Give me a term. Give me how many months or how many years do we want this mortgage to be for?
30.
30 years. Okay, so 30 years, or how many months? 360 months. Okay, so here's what you're going to do. You're going to take 100,000 and you're going to divide it by 360. And you're going to end up with 277, and let's just round it off, so 78. 277, 78. All right, so let's make sure that everybody understands. That is the principal repaid each and every month. So as you go through this loan, every single month, and now take this sort of in comparison to the constant payment mortgage that we had previously. Okay, let me kind of slide back down here for a second. Okay, so coming back to the constant payment mortgage that we had previously, what you saw was, if you look over here to the principal repaid column, that number increasing over time. Yes? So what we're doing now is we're basically saying that number in the principal repaid column is going to stay constant. Okay? But what's going to change is the interest paid and the payment amount is going to change each month. Okay? And what's going to happen over time is you're going to start out with a much higher payment with the constant amortization mortgage, and the payment, the total payment, is going to get less and less and less over time. Okay? So, just to be sort of somewhat consistent, we'll use the same interest rate we used here, 7%. All right, so let's go back to an amortization schedule here.
So to be correct, the principal amount changes, but the money that we actually always have the payment for is the payment amount, and that reduces every month.
Yes. Okay, so this first couple of columns looks identical. Okay, then we're going to go over here, we're going to have the payment amount. Then we're going to have the interest paid. Then we're going to have the principal repaid. And then we're going to have the ending balance. Okay? So same columns, but we're going to be doing something a little bit different. Okay, so here, what we know from our very first calculation, our principal repaid is 277.78. Okay, now, let's just kind of go down a couple of months. That is going to stay constant. Okay, Everybody with me? Yes or no? And here's the thing that's interesting about this. That principal repaid, that's going to be the same regardless of what our interest rate is. Do you see that? Because we're not incorporating the interest rate into this. All we've done is taken what is the balance of the loan divided by the term of the loan. So that's just simply saying we're paying off that much each month regardless of what the interest rate is. The interest rate could be 0%, could be 10%, could be 5%, doesn't really matter. That portion is not going to change. Okay? Everybody with me? Now, just for fun, what if the interest rate were 0? If the interest rate were 0, then what we would actually have is, and I don't want to write this up because the erase function on this is not that great, but in the column, and don't do this on your paper, I just want you to conceptual this with me for a second. If the interest rate were 0, we would then have 0 written down in our interest paid column. So then our payment amount would be interest plus principal, which would then just be the $277.78, which we would then, and the other, just going to go back to labeling these here for a second. A, B, C, D, E, F, okay? So our ending balance is still going to be our beginning balance minus our principal repaid, okay? Our payment amount, this is where it's a little bit different. Here, we're basically saying C is going to be equal to D plus E, which it is in the other model as well, except here we're working in a little bit of a different direction, okay? So what we've got to do now is figure out, well, okay, how much interest did we pay in each of these months? All right? So, to start with, in month 1, we're going to take the 100,000, multiply it, and we said the interest rate's going to be the same as that other problem, so 7%, which would be $7,000, divided by 12, okay, so 583.33 for the interest paid. Okay, so now let's just, for fun, let's just take a look back at the previous problem. That matches up. Same amount. Did everybody see that? But what's not going to match up is the payment amount. It's going to be more. Okay? So what you're going to do is you're going to add column D with column E. And you get like 861, let's say 11.
So it's less than the other payment amount. The other payment amount was $898.
Okay. It's interesting. Should be. I'm missing.
Is the 277.78 wrong?
No. Oh, I know why. Because it's over 30 years. That's why.
Oh.
Yeah. With shorter terms of the loan, that principal repaid will be really large, and so normally the intro payment will be more. But in this case, since you guys actually chose 30 years, then yeah, it's going to be a little bit less. But we've got a lot of payments. Okay. So 861.11 is going to be the payment amount. All right, so let's go over, we calculate the ending balance. And we end up with 99,722.22. Bring that back over here. okay? So let's stop there for a second, and let's just compare that to the constant payment mortgage. So 99,722 versus 99,684, okay? And because in this particular example, we did end up repaying. Oh, I made a mistake. Okay, I just realized that now. Okay, so this loan was for 15 years. Ours is for 30 years. That's where the mistake was made. My fault. I was thinking it was 30 years. Okay, let's go back. We're going to modify this just so that we can make the comparison. I knew there was something that wasn't quite right. All right, so let's just say that we do this. Well, we can continue. It's not going to hurt anything. Okay, well, the calculations we've done are correct, but making the comparison to the other one isn't going to be comparable because this one's a 30-year loan, that one's 15. Okay, is everybody cool with that?
Well, you did say that the years are not, it's the interest only where the years.
Right. Okay, so let's continue on with this. All right, so now for year or month 2, what we've got is we now owe 99,722.22, and our interest is still 7%. So 69,80.56 divided by 12 would be 581.71. All right, and then now to get our principal, we add the interest and the principal for that month together. $859.49. Okay, and then get the balance, subtract out the $277.78 from the 99,722. 99,444.44. Okay. Go through the same routine for month 3. So 99,444.44 times 7%. You get 69,61.11 divided by 12, and you get 580.09. All right, add that to your principal, and you get 857.87. Okay, subtract out your principal from your original beginning balance. And so your balance should be 99,166.66. Okay, so the downside of this sort of mortgage, as you can see, it is very calculator intensive, and there's not really a good shortcut to in terms of filling out the schedule. What there is, to a certain extent, a shortcut on is for any given month, we can tell you what the balance is. Okay, for example, what if I were to ask you for a constant amortization mortgage, what is the balance at the end of month 12? What would you do?
Take the payment, multiply it by 12.
Not the payment.
I'm sorry, the principal repaid for it.
Yeah.
That's what
So,
I-
okay, so the question I just asked, what is loan balance at end of year 1, or basically month 12? All right, so what you're going to do is you're going to take
The 277.
multiply it by 12, Okay, somebody's got an echo on their speaker. They may need to turn it off.
Somebody's got an echo on their speaker, they need to turn it off.
Okay, so this is the amount that we have paid off of the loan. Okay. All right, who has their, apparently somebody's got background on their, Max, do you possibly have, okay. Now we're good? Okay, all right, so this is the amount that we have paid off over the first 12 months. So what we need to do to find the balance is to simply take the 100,000, subtract out 3,333.36. And so the balance at the end of month 12 would be $96,666.64. The beauty of the constant amortization mortgage is we know how much principal we're paying off every single month because it's the same amount. You know, the 277.78. So all you need to know is how many months deep are you into this loan to be able to figure out how much you would owe, okay? Does that make sense? So if we wanted to know just, this loan is for 30 years, so if we wanted to say, okay, how much are we gonna owe at the end of year 15? Well, here's the beauty of that. Given this is a 30-year mortgage, and we're saying what's the balance at the end of year 15, without even doing calculator math, what's going to be the balance?
50,000.
50,000. Because we're halfway through the loan. That's the beauty of the constant amortization mortgage, is that it's the same amount each month. But if you don't believe me,
It's actually an extra 40 cents.
if you take 277.78 and we multiply it halfway through the loan, which would be 180 months, $50,000, and then obviously 40 cents due to rounding, okay? But we're halfway through the loan. Okay? Make sense? Cool.
So, quick question, you said that this is not too common. When would this kind of be used for? What kind of situation?
Any lender can construct a loan for whatever purpose that they, really have. This was kind of that, if we had to sort of say in terms of historical progression, the easiest loan for calculation purposes was the interest-only mortgage. You could do that, just a simple pad of paper, do the calculation. Same thing for this, a little bit more complex, but the beauty of what this would do is that you would be able to know at any given time what you owe and be able to do that calculation with, once again, pen and paper. Then somewhere around probably the 1920s, okay, then we introduced the constant payment mortgage, which is what we're typically familiar with because of technology. And what they had to do at that particular point in time is, while there were calculating machines that would do a lot of the work, not everybody had one. So what they did was they would publish books of what they would call mortgage constants, okay, which was an amount that they had done the pre-calculation for a given interest rate and a given term, and then you could multiply whatever amount you were borrowing by this mortgage constant, and that would tell you your payment, okay? That's an excellent segue because that's a question on the quiz, okay? So, let's take a look at that. All right, so if you were just listening to what I just said, so from a historical perspective, what you had initially were interest-only mortgages. Then you sort of have these constant amortization mortgages, which are still in use. It's just that they're not as popular because we've gotten so accustomed to the traditional constant payment mortgage, okay? But mortgage constants work as follows for these constant payment mortgages, to where all we need to know is an interest rate and the loan term, either in months or years, okay, to calculate a mortgage constant. Now, what actually is sort of being done is as follows. So let's say that we're going to calculate a monthly mortgage constant. On the calculator, let me just sort of show you the steps, but I'll show you kind of how this works in terms of the table values of a mortgage constant table. The 12 payments per year, and our interest rate, okay, I'm just going to go with 10%, what the heck. 10% interest rate, and the loan term, let's go with 10 years. Or, obviously, 120 in, either way. All right, but what you're going to do to actually do this, and this is really, it's more, you need to understand kind of where this is sort of, where this stuff comes from, is we're going to put in $1 as our loan amount or our present value, and we're going to solve for the payment. Okay, so let's just start with this and see what we get. You don't need to understand it yet, you will in a minute. Okay, in Canvas, I'm going to ask you a question like this, and this is the one and only question in Canvas where I'm saying round it off basically after 4 decimal places, okay? Because I found out something in Canvas, it won't allow you to actually carry something beyond 4 decimal places without it rounding it off, okay? So for the purposes of the quiz, you know, just, I've noted that, but if you're rounding it off to 4 decimal places, you would obviously cut it off here, okay? Now, so what does this number mean, okay? And how is it used? All right, so first of all, what we can do with that number is we can take any loan amount. So if I took and I said, all right, we have a loan amount of $100,000, we would just simply multiply that times 100,000. Okay, and that would be our monthly payment, okay? So, and you're saying, whoa, wait a second. Okay, if you remember, you know, some of the relatively straightforward sort of math that you've learned, you know, anything times 1 is equal to itself, kind of thing, all right? So what we're saying here is that we kind of factor up a little bit. In other words, we sort of say that, okay, if $1 is our loan amount and we've calculated this payment or this mortgage constant, then what we're able to do is take any dollar amount, okay, in this case we took 100,000, but we can take any dollar amount, and that's going to give us our monthly payment for that loan amount. So here's what you would have actually seen in kind of a mortgage constant sort of table. You would have had over here, maybe on the left-hand column, you could have had the term, and you could do it both ways, but you could have the term 1 month, 1 year, whatever, 2, 3, 4, 5, and this could have been, like I said, in months or years. And then over here, you would have had, let's say, the interest rate, all right? And so the interest rate might have been from, let's say, 3%, 4%, 5%, 6%, 7%, and so forth, so on. And then for each loan term, you can imagine, books of these things were published, okay? So for every possible, pretty much interest rate and term, then you would have a mortgage constant. Does that make sense? And then all you would have to do in picking up this book would say, okay, my loan is a 5-year loan with a 5% interest rate, and then whatever that mortgage constant was in that, then you would take and multiply that by the loan amount, and that would be your payment. Does that make sense, everybody, conceptually? Okay? Now, I'm not making you go through and construct, obviously, that sort of thing. That's not the purpose of this. The purpose of this is in several calculations that are done within real estate finance, things haven't really been updated in 30, 40, 50 years, okay? And you still have people out there using and referring to the mortgage constant, the monthly mortgage constant, or the annual mortgage constant, because that's kind of how the calculations themselves haven't changed, but how we calculate has changed, okay? We no longer, I mean, keep in mind, you're saying, well, how recent were people using these mortgage constant and interest factor books? Whenever I first started, college back in the 80s, they were definitely still using them. And they were using them, I would say, probably up until late 80s, early 90s, pretty prevalently. And it wasn't until the early to mid 90s that they kind of stopped using the actual physical book itself. Does that make sense? Okay? So the technology obviously has changed, where it's not, in terms of having to go to a book to get this information, you don't need to go to a book, you can use a financial calculator, but the concept is still the same in terms of the mortgage constant is simply a reflection of the interest rate and the loan term. That's what I'm trying to convey in the messaging, okay? Does that make sense? Yes or no? Okay? All right. Moving forward. Okay.
So on a question like that, you would ask like what the mortgage constant is?
Yeah.
Or, okay.
Okay, we got like 3 or 4 more concepts to go. We're blowing through this pretty quickly, which is not a bad thing. It gives us a chance for, okay, let's talk about accrual construction loans. And we'll talk more about construction loans. This is kind of the intro, if you will, into the basics, the fundamental sort of operations of construction loans. As I had previously mentioned, I think a week or so ago, that construction loans are like a revolving line of credit to a certain extent. And what you do is you go into a bank and you say, all right, I want to build something. I want to build a commercial building. You take them the plans, you take them the cost estimates, your budget, your schedule of kind of when you anticipate each phase of the building being built. And normally, in what I would call a traditional sort of construction loan, your equity in the deal is the land. In a normal deal, okay? Because the lender wants some sort of deposit or something that they can attach to in the event that you build whatever it is that you build and it's a flop or you've got major problems with it, whatever it might be. They have something to attach to, and usually it's going to be you're bringing in the land of the deal. Now, that might be avoidable if you've got some other sort of collateral they can attach to. And that collateral obviously can be cash, could be other properties that maybe you own fully. But normally, barring that, excuse me, you would have the land that you would bring into the deal. So you just kind of assume that's part of it. Now, what they're going to say is, all right, so this building that you want to build on the land, it looks like your total construction budget is going to be whatever. Okay, let's just give me an amount.
60 million.
It's a big construction project, but we'll go with that. What the heck?
Finally using some big numbers around here.
All right, 60 million is going to be your total construction budget. All right, now, and this is probably even a better case of illustrating this. Are they going to write you a check for $60 million that you're going to basically sit in a bank account and simply write checks off of? No, you're not. Okay? And so the case is, they're going to say you in essence have a $60 million line of credit. All right? Because you have told us, and you've given us all the documentation, that this building that you plan on building is a $60 million building. Okay? Now, if that's the case, then what they're gonna say is, all right, over however long, and let's keep it kind of simple. Let's say a 12-month construction period. Okay, that's probably unrealistic for a $60 million building, but let's just try to keep things, simple. We'll sort of say, okay, we've got 12 months worth of construction. Now, here's the thing. Over that 12-month period, you're going to have multiple draws, okay, or withdrawals, if you will, kind of on this particular dollar amount. But in essence, we're calling them draws, D-R-A-W-S, draws. We're drawing down off of this original $60 million sort of line of credit or construction loan. And so what may happen is, okay, during the first month, these are months, let's just keep that in perspective over here. All right, during the first month, we do some site work, okay? We come out with the bulldozers, we clear the land, get the site ready. And let's just say, I'm just gonna pull some numbers randomly. We do $10 million worth of work. It's probably a little bit too much, but I don't care. Okay, I'm gonna keep the numbers simple. $10 million is the amount that we're gonna do all this sort of site prep work and do some, put the concrete slab in, whatever, multiple, potentially maybe parking garage layers, I don't know. We're gonna do a whole bunch of stuff in the first month.
Demolish the building.
Do whatever we gotta do. All right, the second month rolls around. Let's say we do another $10 million. Okay? And then maybe we have a work stoppage for some bizarre, strange, crazy reason. So in months 3 and 4, we do absolutely nothing. We have nothing to be paid, okay, to anyone. All right? Then we come back in month 5. Let's say we do $15 million worth of work. And month 6, we're doing maybe another 15 million. That gives us what, 30, 40, 50. All right. And let's say 5 million here. 0, 5 million, 0, 0. Okay, so I did the math correct. Let's see. Yep, 60 million. Now, is this realistic in terms of this, the layout, in terms of the
No.
dollar amounts? No, of course not. That's not what I'm saying. Okay, we're just trying to do the math here so that you can kind of understand what's taking place. So, in this particular case, $10 million worth of work in that first month, $10 million second month, nothing that took place in months 3 or 4, 15 million in 5 and 6, nothing in 7, 5 million in month 8, none in 9, 5 million in 10, nothing in 11 and 12, but overall, 60 million. Okay, now conceptually, here's the thing that you need to think about. When we make this first $10 million draw, that's when the interest clock starts, okay? But it just starts on that $10 million, okay? So in other words, we're going to be paying interest on that $10 million for the remaining 12 months until the project is done. Does that make sense? Whereas for the second $10 million, we're only going to be paying basically for 11 months worth of interest, if you will, okay? And then the 15 million, you know, roughly both of these about, you know, 6 or 7 months worth of interest, and so forth, so on. So what's going to happen is, as we get down now after month 10, we have fully used our 60 million, meaning we owe 60 million to the lender, and from that point forward, all interest is being calculated off of that $60 million that we have borrowed, plus we have all the interest that has accumulated on this loan over that time period. Now this gets into a kind of an interesting thing. Every loan, every project is different as to what lenders work out with the borrower. In some cases, you would not pay any of that interest until the project is complete. In other words, the interest accrues, okay, over that entire period. In other cases, the lender may say, all right, we want some sort of good faith interest payment maybe during that construction period based upon the amount that you borrowed, kind of like a minimum payment on a credit card, okay? Same concept, all right? So just be aware of that. Now, in our case, we're just going to make the assumption everything's going to accrue, all right? So we're not going to be making any sort of payments midterm at all. So now the question is, well, first of all, what's the interest rate on this? Now, it's another thing to point out. On construction loans, typically, the interest rate is substantially higher than it is on a normal sort of mortgage loan. And the reason, one of the reasons for that, is because the lender has a lot more work, okay? In that, with this project, what is usually going to take place is, depending on the size of the project, and this project would probably justify it, is you're going to probably almost have a, maybe not a full-time person, but close to a full-time person from the bank on site or going to the site on a very, very regular basis, seeing what is being done, making sure that what you said has been done, and what, you know, payments that you're seeking for each of the contractors that are doing whatever they're doing, that everything matches up, okay? But in other words, you're not trying to pull a fast one on the lender and say, okay, here's the bill for the folks who did all the concrete work, but yet the concrete work hasn't been done. Well, the lender is really just going out to the site to verify, okay, the concrete work's been done, they should be paid. Does that make sense? Okay? But my point with that is simply that the lender is going to be more involved than they would in an ordinary mortgage loan with the construction loan, so therefore they're going to charge either fees or they're going to charge a higher interest rate associated with that. Because also there's another risk. There's the project risk that you get halfway through this or all the way through this and market conditions dramatically change. Okay, imagine you were a lender and you had just made a construction loan and the folks were a couple of months into that construction loan, had done, you know, quite a bit of work on the property, and then all of a sudden COVID hits. You know, you've got to be saying to yourself as a lender, what is my exposure here? You know, what am I going to be better off doing? Shutting off the spigot for, you know, the money to complete the project, or going ahead and continuing to fund it, not knowing whenever this thing is done, if it's actually going to be a viable project anymore, okay? For whatever reasons, okay? Does that make sense? So that's one of the big risks, and that's, once again, another reason why typically construction loans are going to have a little bit of a higher interest rate. So I'll give you an interest rate for the construction loan.
27%.
8%.
No, not that much. Okay, let's just go with 10% to keep it simple. Okay, 10% is going to be our interest rate.
What is the rate going on?
I'm sorry?
What is the rate? Like, using 10% as a...
Yeah,
as a number,
I mean,
but
let's put it this way. It's going to be, okay, a normal mortgage loan might be in the, right now, in the 3s. So you would expect the construction loan is probably going to be double that. You know, close to, let's say 7%. But once again, there's a lot of things that get wrapped up into these loans where the rate itself is not telling the whole story. And what I mean by that is you have many other fees and charges that will cause that rate, the effective rate, to be even higher. Because the lender wants your business, but we're not there yet. We're getting there. So, but right now, just focus on just simply the interest rate. Okay.
So these are draws, and then does it convert to a loan after 12 months?
Good question. So, yet again, it depends. In some cases, what will happen is the lender will not be the same lender. But the construction lender, you will have somebody that's maybe a local sort of construction lender. They're familiar with the market, they're familiar with the players, they're familiar with the contractors, all of that. And so they will be, in many cases, a local sort of lender. But then, whenever the project is done, and you get a takeout commitment from the permanent lender, that permanent lender could be someone completely divorced from the geographic region, or it could be, the same person or the same lender, but not necessarily. And now you can also have some that will do what are just called ADC loans, acquisition, development, and construction loans, that will turn into permanent loans. Everyone is different. So it's another one of those things, you sort of shop around and you kind of figure out, okay, what are my options within this particular market? And it changes and evolves all the time. Because just because this lender over here lent you $10 million on your previous project to build a multifamily complex, and you come along 2 or 3 years later and say, I want to do another one of those, they may say, nope, we've got too many of those on our books, we're not doing any more of those, go find yourself another lender. And then you go over here, and okay, they're willing to do just the construction loan, but they don't want to have anything to do with the permanent loan. So it's a constant shuffle in many cases of going from one lender to another, but not in all cases.
Professor,
Yeah.
that question, within that draw schedule, there's something that lenders also do as well, correct? They create a milestone schedule for the completion of certain phases.
Sure. What was the word you used? I didn't hear you.
They create a milestone schedule.
Yes. A critical
That
sort of
carries a prepayment, or not a prepayment, but a penalty if you don't.
Yep. So basically, there's something saying you must have, or you should have, this much of the construction process completed by this date and time, and if you don't, there may be a penalty or some other issue that gets attached to that. Okay, so let's focus on the calculation. So assuming we've got this, and we want to know, basically, how much do we owe at end of month 12? Okay, so that would be the question, all right? So now what we've got to do, what is this going to look like, you think? A cash flow problem, yes? And specifically, what kind of cash flow problem? 3 letters. First letter? N. Next letter?
PV.
Oh, MPV.
Not MPV,
FV.
FV, future value. Because what we're searching for is what is going to be the amount owed at the end of 12 months. We're basically searching for net future value. okay? But, as we talked about and did in class, since we don't have a quote-unquote net future value key on our calculator, we have to kind of do a workaround. So, the way it's going to work is as follows. So, we're going to do 12 payments per year. Okay? And we can go ahead and put in the interest rate if we want to, 10%. All right, so our first cash flow occurring during period 0 is 0. Okay, so our first expenditure is not going to be until basically period 1. So we'll put in $10 million cash flow. We'll go ahead and do that twice. Probably not worth inherently doing the 2NJ. Okay, then we'll just put in 0 cash flow, 0 cash flow, 15 million cash flow, 15 million cash flow, 0 cash flow, 5 million cash flow, 0 cash flow, 5 million cash flow. And we're going to go ahead and put in those last 2 months, just in case there's any issues. Okay? Then after we've done all of that, then we're going to solve for net present value initially. Once we've got that, then we're going to clear the calculator out, and we're going to put in whatever that amount was as our present value at 10% for 12 in, or 1 shift in, because it's 1 year. Okay, so you can either put it as 12 months, as 12 in, or 1 shift in, and then simply solve for future value, which would give us our net future value. Okay, so let's see what we get. Okay, so, and obviously just drag that number down here. Okay, so what we end up finding, just to kind of put things in perspective, what is actually happening here. So, by doing kind of the net present value calculation here first, it tells us a little bit of the story, but in essence, with the discounting of the 10% and everything, then it's equivalent of, in essence, sort of us taking out a loan at the beginning of the year for $57,695,000, and ultimately at 10% interest for the 12 months, accumulating interest on top of that, we end up owing $63 million at the end of 12 months. So it's not the same as us just borrowing $60 million at the beginning of the year, because we don't borrow the full $60 million at the beginning of the year. Okay? So this is just simply telling us that at the end of the year, with the draws that we have done, with the timing of those draws, and the interest rate that we had on those draws, this would be the amount that we would owe the construction lender for this project. So we've borrowed a total of 60 million, and we owe 63 million at the end. Does that make sense? Yes or no? Okay, now, another way to sort of take this information and begin to use it is, all right, this is what we have physically invested in the improvements on the land. Now, this does not include the land, okay? The land would be something on top of this, okay? I'm just going to throw a number out there. So this is what we owe, if you will, on the improvements. But if we were to add, let's say, another 10 million for land, then the total valuation at this point for the site would be, let's say, 73 million. Does that make sense? With land. Okay? Now, this is where it begins to get interesting. Okay? So, okay, let me back up just a hot second because I know some of you get a little worried about things. So, in terms of the quiz, all you need to be able to calculate is that piece of it. Okay? Just give me what the balance of the loan is at the end of the loan term. Okay? Now, this next piece is sort of bonus material. We're going to be dealing with it later, but right now it's sort of bonus material. All right, so we've got $10 million, let's say, on top of this, that's land. So our total value currently for the property, just in terms of what we have in it, is 73 million. Now, this, as I said, is where it gets interesting. Hopefully, you have done an amazing job of acquiring the land at a reasonable price. Hopefully, you have done a reasonable job of doing the construction at or below budget and have gotten good deals with materials and contractors and so forth, so on. And hopefully you've built it in a market that is expanding and has a lot of upward potential.
Can you just shift the screen a little bit up? Set you up? Yeah, perfect.
Okay, so you've done hopefully all these good things. Now, what we may find is that now when an actual market-based appraisal of this property is done, once it's fully completed, potentially occupied or at least with leases in place in the property, that you might find that the valuation might be $100 million. Okay? So if this becomes the market valuation for the property, what does that mean? In terms of profit,
28 million?
yeah, you've got basically the difference between this 100 million and the 73 million, okay, as in essence sort of, at least that's sort of paper profit, okay? You haven't sold anything, so it's why it's paper profit. But if this is the new market valuation, now, this is the part, as I said, that gets interesting, is let's say that your lender allows you to borrow 80% of that in terms of a loan-to-value ratio. That means you can borrow 80 million. Well, you only have 73 million in the deal. So in essence, you could walk away in your back pocket with the difference between the 80 million and the 73 million, okay? And then not have to have any other equity in the deal, okay? Does that make sense? All right? And so...
Wouldn't you have the 20 million though?
Okay. Well, think of it like this. you're able to cash out every dollar that you legitimately have
Right.
in the property, all right? And so what we're saying is, if you're able to get 80 million in terms of a new loan, you're gonna walk away in your back pocket
Right,
in
for
terms of,
6+ million.
Yes.
Right, I got that, but I'm just thinking that if it's valued at 100 million, I have an $80 million loan, I have 20 million in equity in there still, correct?
yeah, but you also have sort of this phantom equity as well.
Okay.
So, but the point being, it's a good thing, it's a great thing, it's a wonderful thing, okay? But this is where, in terms of the real estate development process, the rubber really begins to hit the road, because this is where you have somehow, as I said, you listen closely to what I said, you maybe have acquired the land at a really good price. You have done a really good job in getting it built and getting it built efficiently and effectively with the right contractors, the right materials, and so forth, so that whenever it does get valued, it gets valued for this 100 million versus what you actually have in it. So you could sell it if you want to, literally, right then and there, and it says that you sell it for 100 million, then you would just pocket the difference really between the 100 million and the 73 million. But what we're saying is you don't have to do that. You can still keep the property, get a loan, 80% loan to value. You have now an $80 million loan, and you would still walk away with several $1 million in your back pocket right now that you could spend on other fun stuff. Okay, does that make sense? Or you could plow that money back into the project in some way, you know, that you might choose to do, you know, in terms of extra improvements or whatever, if you think that's somehow going to enhance the value of the property. Okay, I'm just trying to get you to think about how the money can move in different directions. Okay, all right.
You can also use that money to buy out your investors too, can you?
Absolutely. You can use the money for pretty much whatever you want to. All right.
Would the bank know that, or the lender know?
Yeah,
that?
and that's not going to be an issue, because once again, they're concerned about what is the market valuation of the property. Okay? You're not the first person, and I mean this in a positive way, you're not the first person in history to have done this. You know, this is common practice. Now, will a lender, in some cases, you know, not want to bet the farm on giving you a loan that is inflated? They're not going to want to do that. You know, they're going to want to make sure it's legitimate, is what I guess I'm saying. But it's very legitimate that you could have gotten a really good deal on the land up front, and that you did a really good job in the construction process by getting, you know, at or below market cost of construction or construction materials, for whatever reasons. Okay? You know, in a smaller project, let's, you know, you're the one that gave me the 60 million, but, you know, you scale that back to, let's say, you know, it's like a $6 million project. You know, you could have done a lot of the work yourself. You could have had friends and family do a lot of the work yourself, or yourself. You could have taken materials that maybe you had left over, or you got at a bargain basement, you know, so there's a lot of other things that could have contributed to that. Okay? All right, moving forward. Okay. One of the things that we need to talk about are what are referred to as negative amortization loans. So this is where you have borrowed money, and then for whatever reason, either you were not able to make the full payment on the loan, or the lender is willing to kind of cut you a deal on, you know, deferring that payment out into the future. But what ends up happening is you end up with the loan becoming negatively amortized. So what that means, in very simple terms, you borrow an amount of money And if you don't make the full and complete payment on that loan, what's going to happen? The balance on that loan is going to go up, 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 okay? In other words, you're past due in one sense. But the lender is willing to maybe allow that in times of difficulty. You know, they may say, all right, we understand times are tough, just make the principal payment, or just make the interest payment, or just make some other sort of dollar amount payment to kind of show us that you're still in the game and that we don't, because we don't want to foreclose, we don't want to, you know, go down that road. And so we're willing to allow sort of negative amortization to accumulate on that loan. Okay, does that make sense conceptually? All right, so let's just say, for simplicity's sake, we go back to our standard $100,000 loan. And the only reason I like to use $100,000 is it's a nice round number for calculations. Okay, so this is also sort of telling for me personally. Whenever I started teaching back in the late 80s, the typical normal house was valued at $100,000. And so that number has been stuck in my head. I probably should just update it to maybe, I don't know, $500,000. But anyway, $100,000. Okay, $100,000 loan. Let's say that, once again, this is 12 payments per year. And interest rate on this, let's say, is 10%. And yes, to answer the question some of you may want to ask, what were interest rates like 30 years ago? Well, a lot higher. Actually, my first mortgage on my first house was about 8.5%, you know, 30-something years ago. So yeah, 10% is also kind of definitely a prevailing interest rate. Okay, and let's say this is a 30-year mortgage. And we calculate the payment. And of course, know this one off the top of my head, $877.57. All right. Now, in this particular case, that's the loan term, that's the payment. What would happen for this loan if I paid off, or not paid off, but if I paid something less than $877.57 a month? What would happen? Negative amortization. Okay? So, give me a dollar amount that I would pay. Instead of paying $877.57, give me a dollar amount that I would pay.
500.
500. So what I would do is as follows. I would put 500 as my replacement payment. Okay? Now, in so doing, let's say that I have to make that payment for how many years? Give me, or months?
6.
6 years, okay? So for 6 years, I'm going to make that payment. So what do I need to put in?
It's 72.
72. 6 times 12 is 72.
And the one just represents its
You're beginning at month 1, going to month 72, but the reality for this problem, because what we're really going to find out is what is your balance at the end of month 72. We could have also put in 72, input 72. Either way, because what it's going to be the same, the balance is going to be the same. Okay?
So it's better to write 72, 72?
Either way. I mean, as long as the second number is 72, it's going to work. Okay, so if you're thinking and you're not just punching numbers, how much negative amortization has occurred here?
Oh, you change that to 72?
30%.
Either way, it's not gonna matter. This could be 1, it could be 72, it doesn't matter, because what matters is what this is.
Oh, I
This-
got you.
The balance is gonna be the same.
32,000?
Yes, okay, so 32,703.77 is the amount of negative amortization that has taken place on this loan, because the original balance of the loan was $100,000. So because we have not been making our full payments of $877.57, we've only been making $500 a month in payments, we now owe $32,703 more on the loan than we borrowed. Thus, negative amortization
After 6 years.
after 6 years. Okay?
So
So what would have to happen now, and this goes beyond the scope of the quiz question, but what would have to happen now is you would have to say, okay, if I'm going to be able to pay off this balance over the remaining 4 years, what would I have to do? My payment's going to have to be bigger than $877.57 in order to be able to accomplish that.
So your new purchase value would be 132?
Correct. And we're going to be doing problems like that, just not today. Okay?
So you wouldn't just use the first equal for the principal and you get the 32,703 for like the amount of the negative amortization?
You can probably get it a couple of different ways,
Okay.
but all I'm really saying, more than likely the question is going to be something like, what is your loan balance at the end of, in this case, 6 years?
Okay.
Or it could be, what is the amount of negative amortization that has occurred?
So then you would just take the balance that you get there
Right.
from the original
You
balance.
have to be
Yeah.
quite, you have to read the question carefully.
Yes.
But the point is, but that's the part of understanding, that you're not just boop, boop, boop with the buttons, okay? You've got to get to the point of where you're thinking about what is being asked, okay? Okay, questions?
I just have a question. So the
Yep.
amount of the negative amortization is 32,000 or 132,000?
The amount of the negative amortization, because that's the additional amount, would be the 32,703. The total loan balance would be the 132,000. Okay? Because what you're saying is, if you did all this, and you say, okay, I want to just pay off the loan right here, right now, you would have to cut a check to the lender for $132,703. Okay? Got it? Okay. Moving forward. Sure, we've got one topic left, just want to double check.
A restroom break?
Sure, or, okay. Okay, take a quick 5-minute break.
Work at a mortgage company right now, and nobody wants to touch a reverse mortgage.
What about Morgan? Yes. Yes.
Yes. Would you mind scrolling back up to the accrual construction loan? I just want to take those notes. I missed that.
What were you saying? That's not surprising?
No, they're horrible. Horrible ideas.
Thank you.
That sounds horrible. I gotta stop laughing. Have you taken the GIS quiz yet?
I'm gonna take it tonight, it's a short drive home, so, but I have some questions for him, because I just hope I don't have to download the zip file.
on Canvas. I'm not sure how it works, but did you take it, or?
Yeah, I took it last night.
Is it easy, or?
Yeah, I thought it
Yeah,
was.
just follow directions.
Yeah, follow directions. You gotta download a file from the Broward County site.
Oh, I see, okay. Because I wasn't sure if that was gonna be on Canvas or Word.
Yeah, so we gotta download a file from the Broward County site.
And it's just like the, you know, what we did in class the past.
Yeah, the first 2 weeks. So yeah, so you do the download the file, you add the layer on Arc Online.
Yeah, the same like
And then
in
you do a
class.
separate thing, like a different thing in the business analyst.
Okay, that's simple. But how do I like put it into Canvas? Because he said he'll just see it on his app.
So when you start the quiz, it shows up as like 11 questions, but the questions are pretty much steps,
Oh, okay.
directions for you to follow. There's only, you upload a file on one that you download.
But
You
because
put it
he
in.
can see everything, like what we did. for
Yeah,
ours.
because he can go into our online, and that's exactly what it is. So, yeah, you upload a file that you get from business analyst. You put it in a number that he asks a question about.
And there's no like Citrix server, right? Since you can see it on his end, right? Because it's organization. Yeah, okay.
Yeah, and I was like,
Is that like, you know, I read the email that he sent, and I was like, you know, it's fine.
yeah, I mean, it honestly took me about 30 minutes to do. I submitted the quiz about 45 minutes.
There's the time limit.
Because I went through it 2-3 times just to make sure I'm like, okay, I did this, okay, I did this, I did this, I did this, I did this.
So it's basically follow instructions and that's it.
Yeah.
And nothing sophisticated or crazy. Wow, that's really
If you halfway paid attention in class, you should be fine.
good. So I assume you're ready to go to the beach now.
Oh, hell yeah, man.
Are you gonna go to the GIS class or
Yeah, for sure.
what are you doing for lunch?
I have no idea. There's a Vicky Bakery over there, might get some.
I know Vicky Bakery. I know Vicky from Vicky Bakery.
Yeah, there's a ton of them over
I almost dated her. Swear to God.
there. Wait, what?
I almost dated Vicky from Vicky Bakery. She went to school with me.
Seriously?
Swear to God. KO.
Damn, she's young, huh?
1 year younger than me. So that would put her at 29.
Damn, she's 29, she got a bunch of Vicky Bakeries, huh?
Yeah, first one originated in Hialeah.
Damn. What about them heaters, man?
I was laughing because Reggie Miller was like saying, wow, they just ripped the heart out of the #1 team.
I couldn't believe that fourth quarter, man. I couldn't believe it, man. And I was surprised Houston won, too.
I love that one of my cameras is frozen on my gut. So Lily, I've got the gut cam up there or something.
That's funny.
And the sad thing is, that would ordinarily be the camera that people would be using exclusively in the classroom, so it's frozen. Thank goodness, I've got the extra stuff. Okay, somebody's got something on the background. I don't know, because we're getting feedback in the room here. So is it, Chris, is that you or? Okay, how's it working? Yep, okay, it's working now, perfect.
Oh, there's also like a really good hoagie place right over here on University.
Las Patas?
I can't remember the name of it.
I think it's Las Patas.
It's been a while since I've been there.
Okay, as those of you in Zoom land are getting back to your locations, go ahead and get the cameras back on so I know you're there. Because believe it or not, I do look over there to get a sense of what's happening. Okay, so the final official sort of lecture topic for the day, at least in terms of the quizzes, is the topic of reverse mortgages, also known as how to take advantage of old people. So these are horrible, horrible things in terms of their usage. And they have been used for at least 30, 40 years. And almost in every single instance, they end up in a horrible set of circumstances for the person that has taken out one of these loans. As always, there are exceptions and things that have gone well. But once you understand and I explain kind of what these are, you'll begin to sort of see what I'm talking about. So, what are they? All right. So, assume, and I can say this because I now fit in that category of older or person. So assume that you're an older person, you have bought your home and you have paid off your mortgage, okay? The American dream, you have, paid your 30-year mortgage, you're done with it, you own it free and clear, and then you're migrating yourself into the world of retirement. And in so doing, you're saying to yourself, wow, I didn't do as good of a job as I should have in terms of putting money aside for my retirement. Social Security is just not enough, and what little pension or 401k that maybe I have is just not enough to live on. And I don't feel like going back to work, so what are my options? Well, one of your options might be take a reverse mortgage out against your personal residence. And, on the surface, it potentially sounds like a really good idea because you're saying, all right, I've got this, let's say $500,000 house, all right? And it's bought free and clear, no outstanding mortgage. And so if I can do a reverse mortgage on this, and potentially be given pretty close to that entire amount up front, given that as a cash check, or more commonly would be given as maybe an annual or monthly check from one of these reverse mortgage providers. And the way that it may be set up is that let's assume that let's just say I'm 65 years old. Okay, and if I'm 65 years old and I do a reverse mortgage for 15 years, then that basically would give me payments from 65 to what? 80, right? Mm-hmm. And, if you make the assumption, okay, after 80, then we're going to have to come up with something else, but at least for that period of, let's say 65 to 80, I could be getting some extra payments. Now, we can make a reverse mortgage longer than 15 years. You make it 20 years, maybe 25 years, but the point is, what's going to happen is you're going to have a valuation done of your property, and then you're going to have an interest rate that's going to be attached to that, and then you're going to be given payments either annually or monthly by a lender based on that, and then at the end of this reverse mortgage, you're going to have, in essence, an outstanding balance of, and in the case of the $500,000 house, $500,000. So at the end of that, let's say 15 years, you got a couple of choices. One, you move out of the house and you sell it or give it to the reverse lender. They sell it, you refinance it, or you do something else. But the thing is, you now owe $500,000 on that house, okay? But you've been getting payments for the past, whatever, 15 years on that. Now, the downside of this, of course, is, well, you live longer or substantially longer than what that reverse mortgage is for. So now, once again, making that assumption that we went from, age 65 to age 80. So at age 80, what are you going to do? You now have no house. All you have left is potentially whatever savings that you may have had and potentially, Social Security and whatever else. And so you're sort of left, to a certain extent, with very minimal assets, if any, and you're sort of out on the street. Okay? Now, some of these reverse mortgages are set up to be life estates, where they allow you to maybe stay there your entire life, and then once you die, it's a horrible thing to think about this in the way that they're set up, but once you die, then the property will then be reverted to the reverse mortgage folks. Okay, does that make sense? Okay, Max, you have a question?
Yeah, the screen is blank and your camera number 1 is frozen.
Yeah, I knew that camera number 1 is frozen. So when you say the screen is blank, does it not have the reverse mortgages up there?
The only words are reverse mortgage.
Yeah, that's all that's there. That's all that's there. For right now. Now, so let's just take and say that we have 500,000. Is that showing up on the screen?
Yep.
Okay. Yeah, the other camera, I don't know, the one on the lecture station is frozen. But that's okay, there's nothing there to see except for my gut, so it's okay. All right, so we have the 500,000 is, in essence, going to be, this is the part that you have to kind of wrap your head. First of all, okay, we're going to make this monthly. Could be annual. But this 500,000 is going to be a future value, okay? So this is where it gets kind of weird.
Would you consider that like a loan amount?
Well, okay, follow me through and then we'll kind of explain. So in essence, what we're saying, that 500,000 is going to be the value that the lender is saying that your home is going to be worth, in essence, in, let's say, 15 years. Okay? And then they maybe charge you, let's say, or the discount is, let's say, we can make it whatever we want it to be, but let's just say it's 8%. Then what, in essence, let's start with this for a second. And we're going to make a couple of little adjustments to this, but I just want to, we're going to start with this. Okay, so that would be basically the monthly amount that we would get for 15 years on this reverse mortgage. Now, if we just do some simple math, that would be for how many total payments?
1 year.
So, this is the thing where you begin to start looking at this and you begin to say, okay, maybe this is not such a great thing. Because if you look at this from in essence, the person who's getting the reverse mortgage, we're basically saying, yeah, your house is going to be worth $500,000 15 years from now, and we're letting you basically accumulate up to that amount over the next 15 years, and we're making you payments every month for $1444.93. But if you just do the math, the bank is only giving you out of their pocket $260,000. Does that make sense? Okay. Okay. So, what is happening? Here's the way you have to think about this. The bank is just going to be doling you out $1444.93 for the next 15 years, 180 months. All right. So at the end of that 180 months, you're going to owe $500,000. Okay, or your balance is going to be $500,000, meaning you would have to sell the house for $500,000 in order to pay off that reverse mortgage and move on. But the reality of the situation is all you're really receiving in terms of hard cash currency that you can spend right here, right now, is the equivalent of $260,000. Okay? In other words, you would probably be better off selling your house now and either leasing it back from somebody or moving on to do something else. But and so the question that many of you begin to ask, why would anyone do a reverse mortgage? Because people want, in many cases, to stay put where they have been for the past 30-something years. And they're saying to themselves, I don't want to move. So I'm willing to take this horrible deal to be able to stay where I'm at because I've got to have some money to live on. And in essence, I'm willing to do that and take a huge discount of what my house is really worth simply to basically live. That's what I'm saying. And I was joking, but I'm also serious when I say it. It's basically a scam, you know.
But why would they not take like a loan for $260,000?
They could, but then they have to make monthly payments to pay it back.
So would they qualify, without a job?
Right, that's a whole other thing.
Yeah.
This is sometimes their only means of getting money. Okay, I mean, put yourselves in a situation. You no longer are working. You no longer have, maybe even the ability to work, possibly, So, and you don't necessarily want to work. You've been working your whole life, now is your time to supposedly kick back and relax. So, and as I said, it's tangled with this whole thing of you become emotionally attached to this property or this location or whatever it is, and you have no other options. So you're sort of left with this kind of horrible sort of decision that you've got to, in some cases, make. Yeah.
I'm just curious, at the beginning of the segment, you said that there are instances where reverse mortgage might make sense. Like, what type of instance would that be?
Well, I mean, it makes sense. If this is your only possible option. Okay, somebody's turn off their speaker because we're hearing feedback. Chris? Okay, so as I said, the question was that I had said, in some cases it makes sense, and it does. Okay, let's assume that you're a single person, you have, or husband, wife, whatever, and you have no other financial means of support other than potentially Social Security. You have virtually no savings whatsoever. Either you're going to be out on the street because you can't pay. You still have bills. You still have water bills, electric bills, insurance, car payments, gas. Or I'm sorry, car payments, but gas. And other associated living expenses. You got to come up with money to do all of that. Well, if you don't have enough income, this may be your only option. I'm not saying do not, under any circumstance. I think it's a great option. I think it's kind of like an option of last resort.
Okay.
They're marketed very well too.
Oh, of course.
They always sell it,
They always get the most, attractive actors that have aged very well to basically come in and promote, these sorts of properties. I think one of the more recent ones I saw was with Tom Selleck, that did these. But yeah, but these things have been going on for many years, and ultimately, it's a product out there that unfortunately does tend to take advantage of people. Okay.
And they just could sell it at 500. Like throughout those 15 years, if they decide to sell that house, they have to sell it for more than 500,000.
No. If they decide to, okay, If during this reverse mortgage that you were to decide to sell it, if that reverse mortgage gave you the option to, then you would have to pay off whatever the balance that you've accumulated up to that point.
Right, before you said 500,000 would be the balance, but that's not including the interest in that.
No, that's why this amount of the payout is so much less. The difference between the 500,000 and the 260 is the interest that basically the lender is getting off of the money that you've basically been receiving.
So the balance would be 500,000?
Yes,
Okay.
yes, at the end of the 15 years. But his question was, what if midway through this, you're like, I don't want to do this anymore? Then you would have to pay off whatever the balance is at that particular point in time, which, you know, is not going to be maybe the full 500, but it's probably going to be at least a couple 100,000 or more.
Now, the future value, is it based on the equity of the house or the actual like appraisal of the value of the house?
This is where it gets really dicey, because part of what the sizzle is on this is that the lender is basically going to this borrower and saying, your house is maybe currently valued for, let's say, 400,000. But what we're going to do is we're going to give you a reverse mortgage for 500,000. Because they're going to make the assumption that the property is going to go up in value over 15 years, maybe from 400 to 500,000. That's one way they might try to sell it. Or they may just simply say, okay, your house is valued at $500,000 today. That's the maximum value that we're going to give you 15 years from now. And some folks are going to accept that. Does that make sense?
Yes.
Okay. Now, simply put, we're going to make a little adjustment to this, okay? I'm going to introduce a new concept to you, and this is going to be something you're going to have to utilize in the quiz, okay? But you understand fundamentally how this works, yes? Okay. So now we're going to talk about something that we only tangentially touched on, and I said I would get back to it, and now I'm getting back to it. And that is the little begin-end function on your calculator. Okay? Over on the right-hand side of your calculator, underneath the margin key, MAR, are the words in gold, begin, or BEG/end. Okay. What happens in some cases, very few, but in some cases, we have to make adjustments as to when cash flows are made and or when they are received. Let me explain. So, in this particular scenario, we've got a situation of where from the lender's perspective, they are going to get their $500,000 back at the end of 15 years or 180 months. Okay. Now, these are months. So month 0, or time period 0, month 1, month 2, month 3, those are, I'm going to write specifically. These are months. Okay. So it's obviously not to scale. That's why it's a little squiggly line here to indicate not to scale. All right. Now, so what is happening in the scenario that we have just provided? Well, nothing is happening at time period 0. What is happening is 1 month into this, the lender is making a payment to that person with the reverse mortgage of $144.93. At the end of the next month, $144.93. 1,444.93, and so forth, so on, all the way out. And the final payment is received here in month 180 of 144.43, okay? So the lender makes their last payment, if you will, on that very last month. Okay, that is how we currently have this set up. Is everybody clear with that? Yes or no? Okay. Now, here is the change that we are making to this, because this is kind of how it's done. If what we want to do is adjust when these payments are made to the older person, if you will, and we want to have the first payment occur immediately upon this loan being enacted. We want everything to shift forward one full period, even including this last one, would shift back where the final payment would be made at the end of month 179 or the beginning of month 180, okay? In order to do that, we use the begin-end function, all right? And so what would take place is you would start the problem, kind of clear everything out, go over here, start with shift, begin, end. You've already got your 12 payments per year. Put in the 500,000 as the future value. 15, shift in. 8%. Now solve for the payment. You're going to get a different number, okay, than we previously got.
Excuse me, you have you starting.
Okay. So basically you're putting in the same exact problem, but all you have done differently is before you start this problem, you hit the shift and the begin end. So now in the calculator, up in the display, it will say BEG, begin. Okay, now I want everyone in Zoom land to look at me. I want all of you to look at me. This is the only problem on the quiz that uses the begin-end function. Once you have turned on the begin-end function, it will have BEG in the display. To turn it off, you have to hit shift, begin, end again to get it back to normal. If you fail to do that, every single problem that you will be doing will be wrong, okay? So make sure that you only use the begin-end function for this one problem. And I purposely, to try to keep you from screwing it up, and I mean that with all the sincere respect I can possibly offer,
Put it as the last one.
is I made it the last question on the quiz, okay? All right?
I was going to say, save it for last.
I did. So, but here's the thing. Given this is the last question that we are doing right now together, after you finish working this problem right now, put it back in regular end mode, okay? Where, in other words, begin is not in the display. Okay, does everybody hear me? Nod your heads up and down.
So you have
Okay.
to push
Because I do not want, nor will I accept any excuses for the other problems being screwed up because, oh, Professor Forgy, I forgot to put it back in begin or end mode and everything's screwed up. No, you've got to make sure you do this. I mean, we all make mistakes. Even I make mistakes. I made one mistake on the first day and I'll never forget it, okay? So everybody makes mistakes, but you can't make a bunch of mistakes, okay? That's a bad thing. Okay,
So put the
hold on.
numbers in.
So, now, so once we get this, you see that number is different than that number. 1435.36 versus 1444.93. What I want you to do now is I want you to think in your brain why they're different and why the one that is in begin mode is lower than the original one that's in end mode. Because here's what's happening. The one that is in begin mode the 1435.36. The way to think about it is I, as the old person getting this reverse annuity mortgage, I am getting my first payment now immediately, right this second, the moment I take out this loan, okay? I'm not having to wait a month to get that first payment. So because I'm getting it sooner, that means, in essence, I am going to be getting less, okay? Because I'm getting my money sooner rather than later. Does that make sense? Yes or no? Okay? Now, you're going to say, okay, well, it's only, you know, not quite even $10 difference. Yeah, sure. And you're saying, well, why did you go through all this brain damage to have us do this? Well, because in practice, most of the reverse mortgage payments are set up this way to where the first payment occurs at the minute you get the loan. Does that make sense? Okay, now, for those of you that just simply want to kind of, okay, and actually let's go ahead and do this real quick. Just, all right, so after you've done this, go ahead and switch it off. Okay, to make sure that you're back to normal. Okay, let's first of all do that. Okay, now, this concept that we just sort of talked about is the difference between what is referred to as an ordinary annuity versus an annuity due. Okay? An ordinary annuity occurs at the end of the period. The annuity due occurs at the beginning of the period. So, just like what we sort of talked about, that we have a little timeline here. Now, this is not on the quiz, so you can just kind of relax, but I'm just trying to illustrate the concept. So, let's just say that we had a loan that, or payments that are being made. An ordinary annuity would be, let's say, okay, we're getting $100. All right? That would be maybe the example of the ordinary. So all the annuity due, by comparison, is shifting everything back to where instead of getting 0, you're getting 100 here,
Sorry.
100 and 100, and then 0 here. So all that's happening is just a shifting. Okay, does everybody see that? Okay, and that's just to illustrate the concept of what is referred to as an ordinary annuity versus an annuity due. It's just a shifting of one period. Now that period could be 1 month or 1 year. Okay, so it's kind of like saying the payments occurred at the beginning of the month or at the end of the month. Or payments occurred at the beginning of the year or at the end of the year. Okay, so that language is going to become very important in some of the future calculations that we're going to do. Not today, but I just want to make sure that you understand conceptually what's happening. Okay? The only difference between the sort of, this one is, this is the begin mode, this is the end mode on the calculator. Okay?
So that the interest is not accruing?
It depends on what, for that specific problem. In some cases, yes. In some cases, no. Depending on how the problem is set up. Okay? Okay. Yep.
Well, I was going to ask before, so do we need to use the begin-end at the very beginning of the problem? Or
Yes.
Get it in? Okay.
Well, okay. I'm going to say yes because I don't want you to screw it up. Okay? But what you can actually do is that if you had solved this one over here, and then you just simply hit shift, begin, end, and then resolve for payment, it will do the conversion.
Oh, okay.
But I don't like to tell people that because then they screw up and they forget to take it away. So
Yeah.
it's better just to sort of think of it as keep it contained within the problem. Okay? There are a lot of little shortcuts, and we will maybe embed some of those as we kind of go through, but I try to not overly complicate it as we're getting through the basics.
Sure.
Okay. Any questions? All right. So that gets us through what we need to get through for today's little quiz. All right. Which once again will be the same as kind of the previous ones. You'll have 45 minutes starting today at 11:15 to kind of get through. So now we've got quite a bit of time, almost an hour, to talk about anything else that you guys want to talk about. And then I can also introduce some new stuff that may be covered next week. So it's just like, you know, I'm going to leave it kind of up to you as what we want to do. So I'll start out with questions, and then if there are no questions, then I may jump into some new stuff. Okay, Max?
For the reverse mortgages example, what would be the answer to the question? Which number would it be? The 260,000, the 144, or the 140?
It depends on what I'm asking. If I'm just simply asking what is the dollar amount of the payment that a person would receive each month or each year, then that's how you would respond. If I'm asking you what would be the total amount of cash payouts to the reverse mortgage borrower, that would be a different answer. So it totally depends on what I'm asking.
The 260 is total amount to borrower, and the 144. Do you ever use the 144? Or
No. I mean, as I said, if I simply ask you what is the monthly payment given to the borrower, then it would be, given that we're doing it on begin end mode, 1435.36.
So just completely ignore the 1444.
Well, yes, for this type of problem, yes. And the total payout to the borrower for the reverse annuity, or for the, because this one is going to be slightly different, obviously. So you still are going to have 180 payments. So the amount of total payout would actually be 258, 364, 45.
Because
Okay.
because here it's like says minus 260,000, but we answer like in that.
Yeah, and so what I have done in most of the quiz questions, I have tried to go in, and if a number potentially is negative or positive, I'm giving you credit for both, or either, okay? So, and so what I have found in Canvas, and I think some of you have figured it out as well, is number one, yes, you do need to be precise with your answers, and I do go back and have gone back to look and to see if I need to adjust anything, and I've done that and have made those adjustments, and haven't necessarily notified you, so you need to kind of go back in Canvas and just see if I gave you credit for one that was marked wrong, and for whatever reason you were off ever so slightly. Yeah, the way that Canvas grades it is it's either it's absolutely right or it's absolutely wrong in the sense of and so you just need to make sure that you are giving it a precise number. Otherwise, whenever I go back, I'll catch it, or should. Yeah. Okay.
So you're not inputting multiple answered options into this quiz question.
The only multiple options I'm putting in are in many cases positives and negatives.
Okay.
So and I'm only doing that just because I know that some people are going to enter in things as a negative answer, even though it really is a positive number, but they're entering it as a negative because that's the way the calculator spat it out. Okay?
When I multiplied $1,444.93 times 180, my number was 260,087.40.
It's probably because you may have rounded off the 93. I just left in what the calculator had as the total, sort of not rounding, to get that number. But once again, this would be an issue of If it's off in Canvas, I will make the adjustment.
Okay, all right.
Yeah, don't get worried about those kinds of things. Those are the least of your, not concerns, but those are the ones that are not going to be overly problematic.
These are my problems. But my other question is, where and what's the difference when you can put in, say, the time, the term, and the interest rate in what order?
I was wondering when someone was going to ask that question.
Okay.
Because normally I actually talk about that. Simple answer, doesn't matter. Okay? And the only thing that matters, so the question was, whenever we're doing a lot of these problems, for example, here I put the future value in first, then the term, then the interest rate. I could have put the interest rate in first, then the future value, then the term. What matters is the last thing that you put in is what you're solving for. The inputs don't matter. Think of it like this. You've got, an empty equation. You're just simply putting in, here are the three inputs, but the last thing that you want to do is what we're solving for.
Right.
Okay? But excellent question, because it should be a question you ask is, well, is there any order to, these
Well, I
things?
think that's part of my issue was that I was getting so wrapped up in, like you said earlier, memorizing how the functions are, how the calculation is, instead of logically thinking about what am I solving for.
Once you make that transition to the logic, the lights all begin to come on, it all makes sense. Until that point, it's a chaotic, confusing, frustrating, irritating, maddening experience. It is. But that's why I have people go through it the way that I do, is that ultimately the light comes on and you're like, yeah, now I get it, now I see it. I'm making maybe a few stupid mistakes, but I get it. Yeah. Okay. Other questions out there in the Zoom gallery?
Question, Professor Forney?
Yep.
Hello?
Yes, I can hear you.
So after the reverse mortgage is complete, are you saying that they have to sell, or they have to, how would they repay the mortgage?
They don't. They move out.
They don't. They move out.
They can also die
Oh,
before.
so the bank's off, that's it.
They can also die
Yeah.
first.
Yep. That's pretty much their only option is moving out, or if the reverse mortgage allows them to sell it, it may not. It may be a situation of where they're not even allowed to sell it, because the assumption is, well, you've already kind of done that with reverse mortgage, but if they are allowed to sell it, but they would have to sell it for more than whatever that balance is in order to pay off that lender and walk away with anything.
So no matter what the lender, it's the lender's property after.
Yeah.
after the second.
Yep.
Fair enough, how's the deal?
Are
Okay.
they assumable? Like when you have a
Not-
date there or something?
Not normally, and that's actually it's an excellent topic. We can talk about assumability here in just a moment, but in many of the cases, not so much. I mean, the lender kind of controls that. And so this gets into, putting it bluntly, there are absolutely 100% wonderful, honest, scrupulous lenders, without question. And many of them fit into that category. On the other end of the spectrum, there are many absolutely horrible lenders that take full advantage of people and their lack of understanding, their lack of resources, their, it's just a ploy to make money, pure and simple. And so that's the thing that, armed to a certain extent with the knowledge of sort of understanding how this works, you are at more of an advantage than the average ordinary person on the street that has no clue. They're simply looking at very basic sorts of things. Ooh, my house is worth this. Ooh, I can get this amount each month. So therefore, that adds to what I have to spend. They're not really thinking about the consequences of, okay, 15 years from now, I'm going to be kicked out of my house.
Right.
Okay? All right, other comments or questions from the Zoom gallery or in the room? Okay, so one of the things.
Dr. Ford,
Yep, go ahead.
question. So on that last problem, for the payment, for the negative 14, 35, 36.
Yep.
So below it says begin.
Yep.
At what point does it say end? Maybe.
Well, okay, in the display, it doesn't say end, it's just automatically assumed that end is normal.
Okay.
And so, if you don't see anything in the display, you're good, okay?
All right.
But if you see the BEG in the display, you know that you need to change it, and change it now,
Gotcha.
okay? Okay, so one of the questions from here in the room, it's an excellent question, we might as well go ahead and start talking about it, we got time to do it. Assumable loans. So, one of the things that can take place with mortgage loans is the possibility of allowing that loan to, in essence, be taken over by someone else, okay? And that's called basically assumability. Like, for example, let's say that I go out and I get $1 million mortgage on a building that I want to buy. And I have that mortgage for, let's say, it's a 15-year mortgage. And let's say I'm, 3 or 4 years into it, and I might say, hey, I'm ready to retire, I'm ready to maybe move on and do something else, but maybe I've got a business partner, or maybe I've got somebody that has said, hey, I want to buy your business, I want to buy your building, whatever it might be. It's possible, depending on how that loan was structured, that I can then, in essence, say to that person, hey, you want to buy my business, you want to buy, the building and so forth. What I would like you to do is, in essence, take over the payments on the loan, okay? Now, here's the thing. Not all lenders will allow that, okay? And in some cases, there will be a clause within the mortgage itself that will say that, if a loan is assumed by someone else, it becomes due and payable upon basically that transaction taking place, meaning you gotta go get a new loan, okay? But some loans historically are set up as assumable loans, and that has a value attached to it. Because, and we're gonna be getting into this a little bit later in the semester, but think of it like this. Let's say the loan that I got a heck of a deal in terms of the interest rate. That maybe I don't know, for whatever reason, I was able to get, let's say, a 2% interest rate, all right? And market conditions over, let's say, 3 years have changed, and now maybe the prevailing interest rate is 8%, okay? Well, that difference of 6% would mean that if you were to go get a brand new loan, you would be paying 8%. But if you can assume my loan that's already in existence, you would only be paying 2%. Huge difference, huge benefit. So that assumable loan has value to you as the potential purchaser or borrower, and I know that it has value from my standpoint as someone that has obtained that loan, that I can potentially give it to you at that lower interest rate. Does that make sense? Okay, what about in the gallery out here? Any questions or thoughts on that? Okay. Now, this also sort of tangential to that, another thing that some of you have brought up is the whole idea of owner financing or contracts for deed. So one of the things that I've done over the years in some of the properties that I've purchased and some of the properties that I've sold is that for whatever reason, it might make sense that if you have an owner, so let's just say that you own a building that's worth $1 million, okay, you own it completely, outright, whole thing, no loan, $1 million, and I come to you and I say, I want to buy your building. And you're saying, excellent, can't wait for you to buy my building for $1 million. So I go to the bank, I go through all the traditional brain damage at the bank of trying to get a loan to buy your $1 million building. First of all, I'm probably going to have to put down at least 20%, maybe 30% of that amount. I'm going to have all sorts of inspections, I'm going to have surveys, I'm going to have appraisals, I'm going to have all this other stuff done just to buy your building. Now, under normal sort of conditions, that might make sense for me to have to do all of that and get the loan from the bank. But what if I've known you for the past 15, 20 years, you've been the only owner of this property, I know the property probably close to maybe as well as you do, so I know the ins and the outs. So to a large extent, getting a survey, getting inspections, getting an appraisal, doing all this other stuff, all these other ancillary costs may be useless. Just, in other words, spending a lot of money for no real reason, okay? And so there may be inherently value in being able to do a deal directly with you instead of getting a traditional loan. So in other words, I just come to you and I say, hey, I'll give you, let's say 10% down. So I'll give you $100,000 cash and you give me back a mortgage for $900,000 for the $1 million property, all right? And then I make payments to you for the next 10, 15 years at whatever interest rate that we agree to, 5%, whatever, and I make payments to you, and then whenever it's paid off, we're done, okay? It's like a normal mortgage. But that can be structured a couple different ways. One is we actually do a formal sort of mortgage where you would transfer, in essence, title to me, and I would be the owner of record, or it could be more of like a lease to own or contract for deed where you would retain title until I make the very, very last payment on that loan, then title would be transferred to me. Does that make sense? Okay, because if you transfer title prior to the final payment and I stop making payments, then you got to foreclose on me, which is another cost. Okay, does that make sense? Okay. Now, if I go to the traditional lender with this situation, I may have to put in a much larger down payment. I will probably have to do a lot of additional inspections, a lot of other, so in other words, on a $1 million building, that might be $20,000+ or more of upfront transaction cost that I would not, plus I can also, if I go directly to you, I can also avoid having to pay commissions because I'm just dealing directly with the seller of the property. So there's no broker involved, it's just simply you and me doing a transaction and we go to the title company and sign some paperwork. Does that make sense? Okay. Thoughts, comments, observations from the Zoom gallery? No questions on any of that? Okay. Now those of you that aren't inherently paying attention or zoomed out, you might want to, I know this is not on this quiz, but just because I'm talking about that now doesn't mean we're not going to deal with it later. Okay? So just kind of keep that in the back of your head. Okay. A couple of other things. Let me sort of take a look at next week and maybe give you a little bit of a preview of what we've got going on. I think. Next week is chapter 9. Okay. So, in chapter 9, all of this is predominantly about cap rates. There's a lot of extra reading embedded in here. And so let's just talk for a couple of minutes and answer some questions as it relates to cap rates. And when we finish with this, then we will be done for the day and you guys can do your quiz or do whatever else you want to do. Okay, we talked a little bit about this on the first day, so we're going to kind of repeat a little bit, but this is, once again, one of the reasons we're repeating it. It's really important. Okay, so for cap rates, remember what they are. Cap rate is the rate at which will help us to attract capital to an investment. All right? And what comprises a cap rate? Usually, at a minimum, it's going to be sort of the risk-free rate plus some sort of a risk premium, okay? So let's explain these two. Then I've got one more thing I want to talk about. So what is the risk-free rate? The risk-free rate, for the most part, traditionally, has been that rate of interest or rate of return that you are able to receive from an investment that is considered to be risk-free. And the closest that we have come to with that are buying government securities, okay? Whether it's government bonds or government T-bills, that sort of thing. And usually a very, very low interest rate for those, but that's kind of like the base foundation. And the idea behind that is that that risk-free rate represents the absolute least rate of return that you would be willing to accept as any investor for anything, okay? But in this case, for items that are considered to be pretty much risk-free. The part that we're most interested in terms of real estate, is the other part, the risk premium, okay? And what actually comprises that risk premium? What makes up that risk premium? How do we go about getting to what that risk premium should be or is, okay? So this is a bit more philosophical, so you can kind of sit back and relax for just a couple of minutes in terms of thinking about this. Someone who has been in the real estate industry for a number of years, that has worked in a specific market and sub-market, has a lot of very specialized knowledge. Yes? They understand, hopefully, what is happening in that geographic region, what is happening with the particular property types that exist within that particular region. They understand all of the dynamics of who the players are, what the regulatory environment is. They, are fully immersed and fully aware of all of those things, okay? A lot of times brokers and agents, they are some of the people within that process, but they're not the complete picture, because you have builders, you have the folks that are actually leasing agents, you have the folks that are actually doing the physical contracting work, you have the folks involved with the local city government in terms of the planning and development staff. But the point is, the really informed player will kind of know almost everything there is to know. Therefore, their risk premium for developing and operating within that particular segment, their risk premium is going to be less, or should be less, than someone who is completely, fundamentally dropped into that market, doesn't know anything about that market, and they're theoretically should have a much, much higher risk premium attached because they don't understand, they don't know what they don't know, and there could be a lot of hidden issues. Like, for example, this could be an absolutely amazing market to develop in the sense that if you can get the project approved by the local government, everything will be amazing. But what you find out after maybe jumping in and buying some raw land within that market is that you have a local government that is very maybe anti-development and will put you through an absolute nightmare of an approval process to actually be able to build anything, okay? So the market dynamics are amazing, everything else about it is amazing, but what you don't really know until you really maybe are familiar with the market dynamics is that whole issue of that horrible sort of circumstance that you may be put through in terms of an approval process. Does that make sense? And so this whole thing, of coming up with, kind of an appropriate sort of risk premium that you're going to attach to a project. So here's what I'm trying to say. Numerically, what we're saying is, if I'm really familiar with an area, I might say I'm willing to accept a 10% overall cap rate or rate of return. But if I'm not, I might demand a 15 or 20% cap rate. And those numbers are probably not the right numbers to use, but the point being is I'm willing to accept a less rate of return if I'm really familiar with what's going on than if I'm not, or at least theoretically. Now that doesn't mean that as a practical matter, you may get people that enter into a market that have no clue and that are maybe willing to set up their property with a much lower expectation of a rate of return, doesn't mean that's right. It just means that they they're getting lucky, or they're being compensated above and beyond maybe what they should be compensated based upon what their risk premium should be. So I said, it's kind of theoretical, but it's what I'm trying to get you to do is to start thinking about it, because what is going to be driving that risk premium is really, to a large extent, going to be unique to that particular investor, that particular developer, that particular player within the market, as to how they perceive what that risk really is to them. Because and so that goes into fundamentally how they price investments within that market. The higher the risk that they attach to it, the lower the value that they will attribute to it. Case in point, and this is kind of where the practical begins to, or the theoretical and the practical begin to kind of converge on this. Let's reverse time. Let's say 15 plus years ago. How would you have rated an area like Wynwood in Miami? 15, 20 years ago.
Not very high.
You would have probably said, what?
Not very good.
Right. You would have probably said, high risk, sort of very undesirable, probably, scary, whatever. And you would have probably assigned, and should, at that point in time, probably in many ways of thinking about it, a very high risk premium to that area. But yet you had players within that market who said, okay, how can we change, modify, adapt, redevelop this market in such a way to remove a lot of those barriers, a lot of those perceptions of risk, and ultimately make the area more attractive, more valuable, therefore reducing the risk premium and ultimately inflating the prices over a period of time. And what's interesting about that is, and I have seen this over, because this is really kind of my specialization, is the whole idea of kind of redevelopment of blighted, sort of deteriorating areas, is that the people who come in at the beginning, who have the vision and have the understanding of the market and what the attributes that this area maybe has, and realize what they can put together in terms of assembling key parcels, is fundamental in being able to sort of drive the long-term value of something like this. I mean, what was the big underlying, or what, even now, what is the big underlying value contributor to Wynwood? Proximity to downtown. Okay? That's still, obviously, a big piece of what gives it value. But yet, in the beginning, what did they do? They got the sort of, I want to be careful, this is, in terms of language utilization, I'm going to try to be as accurate. In other words, you get a more bohemian crowd. Okay, I don't know if that's maybe the right word, I hope that's not offensive to anybody, but you get a crowd that's maybe populated more by artists and folks that are obviously a bit more open-minded about kind of living, working, and that sort of thing, attracted to an area. Then ultimately, and this pattern gets repeated over and over if you look across the country, you get those people, they come in, they make a little bit of an investment, they don't usually pay a whole lot for rent, but they get the area sort of pumped up to be kind of a cool, attractive, eclectic, fun, interesting sort of place that then brings in more people because it's sort of a thing that everybody wants to see and participate in, and so forth, so on, and builds the magic of the area. And maybe live music and all this other sort of stuff kind of pumped in there, and then begins to make it a very attractive place. But then what begins to happen, this is the part that's the interesting part.
The rent's rate.
Well, then those owners that originally were the original investors, they begin to now say, we have created a lot of value. We need to either cash out that value or leverage that value in some way to really benefit us. And so they're gonna, have a couple of different options. One is they will begin to sell off some of those properties at a much higher price point than they paid for the properties. And those properties may be filled with tenants, but here's the issue. If I sell off a property, I bought, let's say I bought it for $200,000, and I sell it to you because now all this inflated value, I sell it to you for $1 million, okay? You have paid 5 times what my original investment was. So the tenants that I had in that property, based upon a $200,000 value, means you may not have to raise the rent 5 times what my tenants were paying, but you're going to raise it considerably if you're going to make a profit. Does that make sense? So what's going to happen is you're going to raise the rent on those tenants. Many of them can't afford it, so they're going to move on, maybe into other properties, scatter around into the remaining properties that haven't been sold. You're going to be then forced to probably find a higher quality of tenant or a more substantially normal tenant. And that normal tenant moves in, is able to pay a substantially higher price, then rinse and repeat, basically, over and over again. Well, what has now happened with Wynwood? For the most part, a lot of those original sort of eclectic, fun, quirky whatevers have been kind of slowly but surely, many of them moved out, and in place you have much more higher end kind of art galleries and eateries and whatever else, plus now obviously higher end projects for living in and so forth, so on, to where it has really become much more normalized. I mean, would you agree?
Yeah.
Okay, I mean, it's not completely normal, but it's certainly more normal than it was. Okay, and so what ends up happening with that sort of migration toward normalcy is then you begin to sort of lose a lot of that original sort of fun, quirky stuff, and it becomes much more mainstream. And so this process over and over and over again gets sort of repeated, and ultimately, there's a lot of value creation in there for those initial folks who are willing to kind of take on that process and kind of move it through that process. Okay? Thoughts, questions, observations?
Do you see that happening
Yeah,
in
but-
Overtown?
To where?
In Overtown.
I think there are definitely some possibilities there. There are always barriers that you have to overcome in some of these cases, but, and one of the things I critically, are critical elements of success in something like this is the whole thing of being able to assemble enough properties that you control directly or indirectly so that you can kind of get enough momentum to be able to push it in the direction that you would like to see it go. And in some cases, that's just simply not possible. But it definitely, it's one of those things that by being able to control or influence directly what's happening there, then you ultimately, can maybe move it in a direction that you really want it to go. Okay, question in Zoom gallery, I heard somebody about to say something.
Yeah, I was going to say, in studying that area, because I'm building in that area that you just mentioned, there's degrees of normality. So the people who were there before, they saw Wynwood as being normal because it was home to them. Then the area, became a little gentrified, and you see what you see today. So that becomes the next stage of normality. And then you get into a period of overbuilding, and when you get into a period of overbuilding, then the price points seem to kind of go up because that's what's happening over there now.
Yep.
And so that's another degree of normality. And then the people who are there today no longer can afford to live there, so they leave in search of more affordable living. And then in comes guys from Central America and South America who have deep pockets. They move in, and it becomes a completely different place. And then you'll finally end up with something that looks like Rodeo Drive in California, where no one can really afford to live there other than the people who have the money, and it just becomes a tourist spot for the people who can't afford to live there.
Yep. And you literally have, in a great way, have just said, what I'm trying to sort of get at with this is that this incremental change that occurs, that everyone that jumps into the real estate investment sort of game, you know, I don't want to call it, because I don't think it's accurate to say it's the bigger fool theory of somebody that comes along who's willing to pay more than the previous person, who's willing to pay more than the previous person, and so forth, so on. But there's an element of that, you know, in the sense that, you know, if you buy something, part of the reason you're buying, what's your real motivation, I guess? You know, if your motivation is to buy, you know, and invest and hold long-term and, you know, get whatever, you know, value you can and apply, you know, reasonable rents and so forth to your tenants, you know, that's maybe the ideal way to sort of think about it and to do it. But unfortunately, that's not usually the way it works. Usually the way it works is everybody's about, and I'm not saying wrong, good, bad, that's not what I'm saying. Usually the way it works is people are trying to maximize value, maximize returns. So that even though they bought it for a bargain basement price, and they've held it maybe for multiple years, they're not just going to sit back and say, oh, the tenants next door are paying twice what my tenants are, so I'm going to keep only charging my tenants, you know, half of that. No, they're going to say, I'm going to raise the rents on my tenants as well because I want to get, you know, more money. Why should I not get more money? Now, if they all of a sudden want to get much more, now I hesitate using any words on this. I don't want to get myself into trouble on this, but let's just say that they have a more altruistic sort of perspective on, you know, the tenants in the situation, then, you know, their perspective, you know, might be, I just want to do what is the best for my tenants, and not really thinking about what's more, I don't want to use the word selfish, but what's more my best interest of getting and maximizing the value of the property and getting the best rental income that I possibly can. You know, so thoughts on that from anybody? Zoom gallery.
I'd like to find that landlord.
Yep.
So in downtown, like we're downtown Fort Lauderdale, with all the apartments going up, I mean,
Same
they're all
thing's
going up
happening
at
in
one
Fayetteville.
time. I mean, how does that play with like all the other, like the owners, like, oh, this building's go up, oh, their rents are different, oh, this building's go up now, oh, now we gotta see what they're, it's just a back and forth.
No, it is. I mean, so the question here in the room was about like north downtown Fort Lauderdale, like Flagler Village, you know, that whole kind of area. That, you know, there you've got another, you know, sort of thing going. There, it's been an explosion of, you know, pretty much high-rise, you know, apartments, high-end apartments, and all coming online within a few years, a couple of years of each other. But yet, at least on the surface, up until maybe COVID, you know, the demand seemed to be there. I haven't, you know, really looked in the past few months to see what's happening there. Some of you may be more familiar with in the past few months what's happened, but, you know, before that, they were, you know, still being able to command really high rents, you know, $1.50, $2 a square foot per month for, you know, these apartments, and or higher, you know, depending on the units. And the point, I guess, is that it's interesting because that area, you had all of the residential explosion almost all at once, but what you didn't have happen simultaneous with that, which I thought was really interesting, and it's only beginning to surface now, are the retail and the other ancillary things that you would think would be the amenity that you would want if you were living in a place like that you would want to be able to walk out your front door and instantly walk into a restaurant, instantly walk into a bar, instantly walk into something else, you know, whatever that might be. And for the most part, that really doesn't exist fully in that area. I mean, yes, there are, you know, in the Flagler Village proper, where they've done a lot of the renovations for, you know, some of the different artist community and the, you know, the brew pubs and things like that, but really in the central core of a lot of those really high-end apartments, there's just not a lot of the other ancillary things that you would have expected. Okay, somebody over in the gallery had a question. Max?
Yeah, on Flagler Village, I'm helping BH3 on Fat City, and then we're
Yep.
doing a couple little warehouses in the CRA district that are kind of like lifestyle offices,
Yep.
but right next door to bars and wine walks and other.
Excellent, because that's really what's going to be needed, for long-term viability and sustainability of that area. Because to me, building just a bunch of residential that's high-rise like that. I mean, my expectation would be if I were to want to live there, I would want to be able to walk at my front door and be able to walk into a restaurant, walk into a bar, walk into some other sort of retail that is just simply not there currently. Okay.
Yeah. Another thing about the comment that Max just made. I've done projects in that area too. It's near the Sistrunk area where Flagler Village is located. But a lot of those developments that went up, let's say 8 years ago, that you saw, Foundry and a couple of those other high-rise or medium-rise type apartments or condos that went up. One of the things that most of the developers were banking on was the Complete Streets program that the city of Fort Lauderdale was supposed to be instituting, which they did for the most part along Sistrunk. But another component that they have not delivered on to the developers was the street trolley, so that it would make a loop through downtown Fort Lauderdale, and that hasn't happened yet. The WAVE project.
Yep. Nope. I would agree. And so with the lack of some of those items, that obviously it doesn't give the area as much oomph as it would have with those items. There's no question about it. But yeah, it's just so our whole point, I guess, the whole discussion kind of emanated from this whole thing of kind of transition of neighborhoods and transition of areas that are less attractive into more attractive areas. That what are the things that it takes to sort of get us there? That just building another high-rise building doesn't necessarily get you the quality of the environment that you maybe are ultimately going to need to have it be sustainable long term. So, okay. Any other thoughts, questions? We've got a little more time. Yep, Max.
Can we go over question 16 on the sample problem, the adjustable rate mortgage?
No. No, and the reason, we're going to be covering that ultimately here within the next couple of weeks. I mean, we can go ahead and talk about adjustable rate mortgages a little bit.
But it's not on this quiz then?
No. It will be on a future quiz. But let's just go ahead. What the heck? We can go ahead. We got a little bit of time left.
Just be looking at the solutions. For all the other problems, the solutions made sense logically, but this one, a little bit.
Okay. This is where this whole thing of you guys being out there in Zoom land, me being here, wearing a mask, and so forth, so on, obviously is not as conducive as the normal sort of face-to-face kind of environment is, and we end up usually normally having a lot more questions as I go through things, but in this environment we haven't, so therefore we're going a lot faster than ordinarily probably would. Okay. So one thing to sort of point out, if we kind of go back to what I was saying earlier about kind of technology influencing types of loans that are available, this is yet another example. Okay, let's once again kind of trace this again. We started out with kind of interest-only mortgages. Then we sort of migrated to constant amortization mortgages. Then we migrated to constant payment mortgages. Then what happened sometime in the 1970s was they had kind of the bright idea, and partially driven by out-of-control inflation, but also because the technology existed at that particular point in time to be able to do these sorts of calculations, was to introduce a product called an adjustable rate mortgage, or an ARM. And these adjustable rate mortgages, the idea was that depending on what interest rates do over time, the rate could go up, the rate could go down, the rate could stay the same. And even in today's environment, we still have adjustable rate mortgages. In other words, you go out and get a home loan, you go out and get a business loan, you go out and a lot of these loans are going to be adjustable rate mortgages, where that from 1 month or 1 year to the next, that interest rate could change, okay? Good or bad. So all of a sudden your payment changes. Either goes up, goes down, stays the same. I mean, one of the very first mortgages I had was an adjustable rate mortgage, and every single month the payment changed. So 1 month your payment might be, let's say, $1,000. The next month it's $1,100. The next month it's $1,200. Then the next month the interest rate dropped dramatically. Now it's down to $800. You know, so it's an interesting thing. But a lot of it was born out of lenders saying, hey, we think that interest rates are probably going to be going up over time. So instead of us as lenders locking ourselves in to a fixed interest rate long term, what we're going to do is say, hey, let's do these adjustable rate mortgage things, lock ourselves in only a month at a time or only a year at a time, and then ultimately, so as things change, we're going to be okay as a lender. Does that make sense? So always, when you look at these different sort of mortgage products, you need to always look at them in the lens of what the lender was thinking, okay? What is the lender trying to achieve? Because it's not the borrower that's creating these sort of mortgage products. It's the lenders that are creating these things and marketing these things. Because here's what they could do. Think of this logically. Let's just say the current prevailing interest rate was 10%, okay, to kind of use a nice round number. That's so if you get a 30-year mortgage, let's say 10% interest rate, that's what you're going to get. But let's say that a lender could say right now, hey, I'm going to give you an 8% adjustable rate mortgage, and I'm going to lock that in for a year. But then after a year has passed, then it jumps to whatever the prevailing rate is. Okay? Why has the lender done that? Because they have kind of gotten you in the door with the below market pricing of the mortgage that they're going to call a teaser rate. Okay? They've said, woo, look at this. This is cheap, you know, and they'll get you in the door basically with that initially lower interest rate, but then ultimately over time it will adjust to a market rate, okay? That they may be able to get even more money, a higher rate of return out of you, okay? Now, I'm going to do a very, very simple one, and we'll be doing the more complex ones, you know, probably starting within the next couple of weeks. But let's just do a super simple one here. All right, so 12 payments per year. We've got a $100,000 mortgage. And let's say that our initial interest rate is going to be 8%. And it's going to be a 15-year loan. So we get our initial monthly payment. All right, so our initial payment is $955.65. All right, so let's just say that the rate is going to be 8% for 1 year. Then it's going to go up to 10% for years 2 through 15. Okay, does that make sense, everybody? Yes or no?
Yeah.
Okay, so here's what's going to happen. You're going to get this payment for this first year. All right, and then we're going to do the following. 1 input 12, shift, amortize, equal. Let's get the payoff for that after 1 year. $96,402 15. All right? Then what we do with an adjustable rate mortgage is the way you have to think of it is every time the interest rate changes, think of it as a brand new problem, a brand new set of calculations. So what you're going to do is basically come down here, kind of clear everything out, and start over. But now your loan amount is going to be $96,402.15. Your interest rate is now going to be 10%, but for how many years?
14.
14 years, because you paid off 1 year. So the new payment,
But the interest rate stays the same.
no, interest rate's now 10%.
Oh, it's 10%.
So the new monthly payment, $1,068.33. Okay? Now, this could be one stopping point in a problem of just simply saying, okay, assume that those are the circumstances, assume you have an interest rate change from 8% to 10% after 1 year, what is your new monthly payment? And that could be the stopping point for a question. But we could go much further, which we will be going much further, which is to then say, well, assuming this takes place over 15 years, what is your effective cost of borrowing on this mortgage? Well, that's going to be driven by basically the blended cost of the 8% and the 10%. So your effective cost of borrowing is going to be somewhere between 8% and 10%, probably closer to 10% because the majority of the loan has a 10% interest rate. Does that make sense? Okay? And so that's where we're going to be taking kind of some of the next steps with this in terms of the complexity. But the other things that we're going to be adding into this mix are going to be, what if you pay off the loan early? Are you going to have a prepayment penalty? What if you basically initiate this loan? What kind of fees are you going to be charged by the lender up front in order to actually make the loan at the beginning? Then also, what sort of administrative fees might you be charged over the actual life of the loan itself? All of those different fee structures or penalties are only going to work toward raising your effective cost of borrowing, or what we're also going to call the lender's yield, meaning that this, 8% or 10% interest rate might grow to the lender to be something worth a 15% rate of return by the time you factor in all the fees and the charges, okay? But what you're seeing, at the street level is, oh, I'm getting an 8% interest rate, for a year, and that's what you're all excited about, but not realizing that, number one, it's going to go up to 10% after a year, and you're going to charge all these other fees and charges. Does that make sense? Okay? So that's where we're going to leave it for today, because I can tell you're worn out. I can see it in your faces, okay? And most of the people out here, I can't see their complete faces, but I can see it in their eyes. So, all right, so we're done for the day. Obviously, you've got until Monday night to finish up the quiz. It should be live here in a couple of minutes. Any other questions before we're done? Completely done. Okay, no one wants to take that chance. Okay, good. All right, we'll see you guys then next week. Good luck. I just want you to get your money's worth, okay? Yeah. Unfortunately, like I said, this is like things go a lot faster, I think, this environment.
And there's less people in the class?
Yeah.
Any stuff over there yours?
No. Thanks.
Oh, man, they got an Apple TV in here?
Yeah, they did that a couple of years ago so that people can bring in iPads and use those as tablets.
Oh, I got you, there you go.
I tried using the iPad, it's just, it wasn't as, you know.
How long ago did you try it?
Well, I mean, it works, but I mean, I've got like the latest version, but it's just,
Oh, okay.
this screen, it seems to work much better for what I want to do.
Thanks, Zach, for
Absolutely. Absolutely. See y'all.
have a safe holiday weekend.
Oh, yeah,
The
the
long
lines this
weekend.
week, yeah, I forgot about that. Every day blends together like it's